Section we will be talking about technical analysis, and in particular I will provide you with your technical analysis arsenal, a comprehensive base of technical analysis skills and tools that will help you cover most of the trading situations you will find yourself in. Before we proceed, I would like to underline that whatever we talk about in this section are my views, and all of this is derived from my personal experience of trading. The other tutorials and courses that you might find on the internet, they might have different views and a different variety of skills and techniques to use in the Forex market, and that's totally fine. You're more than welcome to, in your free time, to explore additional skills. However, what I provide you is, in my view, the most important things that will help you in most cases. And to start off with, I would like to quote the Pareto principle, which states that 80% of the effects come from 20% of the causes. And this can be applied to things like 80% of peas are usually contained in 20% of the pods in a garden. 80% of sales of a lot of companies come from 20% of their clients. 80% of work can be done in 20% of the time. That's the Pareto principle, and it applies in lots and lots of situations in life, and I personally believe it also applies in technical analysis. And it's not a coincidence that I called this section Technical Analysis Arsenal, because there's a limited number of skills and techniques that you need to know to cover most of the situations you'll come across. And I believe that the techniques that I'm going to cover in this section are about maybe 20% of the techniques that you can find out there as a starting out trader, and they will cover 80% of the situations that we'll come across. And you'll see that in our live trading. We will limit ourselves to these 20% of techniques, and we'll be able to trade in most of the cases. And so a lot of courses and a lot of books get technical analysis, make it seem very complicated and confusing, and I want to avoid that. In this course, we will look at a limited number of the most efficient, most powerful techniques, and that way they will seem simple, and they are simple, and they will cover most of your trading. Let's sum up in 3 bullet points what we're going to cover in this section. We'll cover techniques and skills that will get you through 80% of situations on the Forex market. And that doesn't mean that you won't know what to do in the other cases. It just means that you won't have to trade in other cases, and you'll find the right situations for these skills and techniques. Not at all, it doesn't mean that you will have any difficulties or trouble. It just means that you will trade when you find these techniques to be working on the market. We will make everything very simple, broken down into extremely intuitive steps. That's the way it should be. Technical analysis is simple in its nature. And everything should be clear. Everything will be clear in this section, because it is important to understand the principles and how they apply. There can't be any gray areas. Technical analysis has to allow you to create a strict trading strategy, which will tell you whether to enter the market or not to enter the market. So those are the 3 things that we'll be aiming for, and that's what you will get from this section. Trends and flats. So one of the most common themes on the Forex market is a trend. Let's try to understand what a trend is exactly. For example, this is how the price has been moving over a certain period of time. Then, as you can see here, we can draw a diagonal line underneath the price, which the price seems to be bouncing off. This line is called the support line. It indicates an upward trend. It means that the price is bouncing off upwards of this line and continuing its upward movement. And so what you can expect in a situation like this is that the price will once again come close to the line and bounce off it and keep moving upwards. And that's how you use the support line. So if you notice that the price has bounced off a diagonal line a couple of times in a row, then there is a good chance that it will bounce off the support line one more time, or at least one more time, and that's how traders using technical analysis would enter into a buy order. A downward trend is very similar, but it's just happening in the opposite direction. So here we can draw a red line above the price, and which is kind of not letting the price go up, which is forcing the price to go down. And this this line, therefore, is called a resistance line. And once again, here you can expect that the price will go towards the line, and there's a high chance that the price will bounce off the line again and continue its movement downwards. So this is called a downward trend, and the line is called a resistance line. And the third type of market is a flat market. In this case, we can't draw a support line or resistance line because the market is kind of flat. It's moving sideways. Some people call a flat market a sideways trend. I kind of try to stay away from that definition because there is actually no trend in the market, so why bother calling it a sideways trend? Finally, in regards to trends, it's always important to check the overall trend on the market. So if the euro dollar is going down, then whatever your other technical analysis suggests, it's always more favorable to trade downwards. If the British pound dollar is going up overall, then you would favor more the signals that tell you to trade upwards. So it's called trading with the trend, and you'll notice that we will be doing that in our live real Forex trading in this course. Alright, so we've already talked about support and resistance trend lines. Now we're going to talk about support and resistance levels. So support levels. Let's imagine a situation where we have a downward trend in the market. And in this case, a support level is a horizontal line, which is called support level, which represents a barrier for the price. So when we'll find out how to look for support levels in a few minutes, but right now let's see what a support level does to the price. So as the price approaches the support level, traders become hesitant because they don't know what will happen. They don't know whether the price will cross it or whether the price will bounce off and move in the opposite direction. So generally you'll notice a kind of consolidation on the market, and then one of the following three things will happen. Either the price will bounce off the support level and go in the opposite direction, or the price might test the support level a little bit, cross it, and then bounce off and go in the opposite direction. Or the price can actually cross the support level and there'll be a massive impulse in the direction of the trend. So now resistance levels. They're very similar, but they're the opposite. They're above the price. So resistance level puts pressure on the price and doesn't and acts as a barrier for the price going upwards. And once again, generally speaking, there's three possible outcomes. Either the price bounces off the resistance level and goes down, or it can test the resistance level and then go down, or it can cross the resistance level and there'll be a strong impulse in the direction of the trend. There are two main types of support and resistance levels, and these are historical and psychological. Let's have a look at the historical type first. So historical levels. Looking at this chart, can you identify any horizontal lines that have been tried and tested by the price more than one time? We can see one of those lines right away. It's this horizontal support line, and the price tested this line over here at first, and then it came back to this line here. And so what can we anticipate from the price's future movement? Well, we can anticipate that if the price does go towards this support line, then something will probably happen over there. So, and that's how you establish support and resistance levels, the historical type. You look at what happened in the past and you see that, oh, wait a second, so the price was hesitant to cross this level previously, or there was some sort of consolidation there in the past. So maybe that same thing or something might happen when the price approaches this level. And more often than not, that's exactly what will happen. There will be some sort of abnormal movement when the price gets to this level, and that's what we take advantage of. The second type is psychological levels. So they're a bit different in the sense that the price is just in a trend, and then we identify a level which is very often a round number. So for example, 1.5000. That is a number that plays with the minds of traders, and because they don't know whether the price is going to bounce off it or cross it. Mathematically speaking, there's nothing special about 1.500. It's no different to 1.650. But at the same time, in a consumer's head, in a normal person's head who walks the streets and lives his life, in his head, his home currency being traded at above 1.5 and below 1.5 are two distinct things. So you might not care whether it's 1.6 or 1.7, but he'll remember if it's 1.55 or if it's 1.45, because that kind of difference sits in your head. Or same thing if it's like 2.0. Like you would know if your home currency or somebody's home currency is trading at $2 per unit of their currency or below or above. So it's kind of a strong level because it's a round number, and traders tend to be hesitant when the price approaches this level because they don't know what will happen, whether the price will go down or up. And same thing as with historical levels, something happens. One of the three things that we discussed normally happens over here. So let's have a look at an example from a real chart. Here I've got the British pound dollar weekly chart, and I just took this out of my terminal, so this is fresh as of today, 4th of February 2015. And as you can see, the British pound dollar currency pair is approaching or has approached this blue support line, and guess what it is? It's 1.5000. And let's have a look here closer. So as we discussed, traders don't know what's going to happen, and these kind of round numbers play with their heads. They're anticipating some sort of reaction or action on the market, and generally the price goes into consolidation for a certain period of time. So traders don't know what's going to happen, and here you can see that's exactly what happened. So before the price reached this level, we had 6 weeks in a row we had bearish candles. You see those 6 white candles going down? There were 6 candles in a row, and as soon as the price got to this psychological level, it stopped. We got 2 bullish candles. So the price went in the opposite direction, and that's because it's testing the level. It doesn't know, nobody knows whether it's going to cross it or whether it's going to bounce off. And so now there's like a balance of power of bears and bulls, and sooner or later one of those 3 things will happen, and we'll see a strong movement afterwards. And in this particular case, you can see that the psychological level is also a historical level. And that's quite common with psychological levels because they tend to be very significant throughout history. So back in January to July 2013, the price tested this psychological level 3 times. And as you can see, it was unable to cross it, and that's when a massive impulse happened and the price went upwards and reached somewhere around 1.7 American dollars per British pound. So now it's back here at 1.5000, and everybody's waiting to see what will happen. So to sum up, there are 2 main types of support and resistance lines. These are trend lines, which are diagonal, and these are levels, which are horizontal. And there are 2 types of support and resistance levels: historical levels and psychological levels. And all of them act as barriers for the price. And when the price gets to them, it either bounces off or we see an impulse when the price crosses these levels. Let's talk about channels for a minute. Here we've got an upward trend, and as we discussed previously, we can draw a support line which represents a diagonal which is kind of guiding the price, and the price keeps bouncing off it in its journey to the top. Now what we're going to do is we're going to take this diagonal and we're going to copy it, and we're going to put it above the price. So there it is. It's got the same angle as the first one, and it's sitting on one of the highs of the price. So once again, as you can see here, the price is also bouncing off this diagonal as well, and bouncing downwards. The price is kind of moving in a channel or corridor. Now what are we anticipating from the price going forward? Well, right now we are probably expecting for the price to bounce off the top border and then to go back up. This is where we would enter into a buy order. So once the price has bounced off, we would wait for it to hit this bottom border of the channel. We would enter into a buy order, and if the price goes in our direction, once it hits the top border again, that's when we would close our trade. So it's important to note here that in an upward channel, it is recommended to trade only buy orders. And why is that? Well, let's take a few steps back for a second. At this stage, we're anticipating for the price to go down. So we could technically conduct a sell order, but it's not advisable for two reasons. First of all, we'd be trading against the trend, and that's something we said we shouldn't do. We should always trade with the trend. And second, as you can see here, the downward movement is actually smaller than the upward movement. So in an upward channel, if you create sell orders, you will always earn less than if you create buy orders. So that's another reason why in an upward channel you should only trade buy orders. Next, we're going to look at a downward channel. So here we've got a downward trend. We can draw a resistance line. If we copy that line, we can see that very often the price will also follow the copied line. So it won't break through it, will bounce off that line. And channels are very common on the Forex market. And you'll see this from our live trading on a real account further down in this course. So here we're expecting the price to go up. Then we'll conduct a sell order and we'll close our order once the price reaches the opposite side of the channel. So once again, in a downward channel, it is advised to open sell orders because you would be, in this case, you'll be trading with the trend and you will get longer movements. And so those are the two main ways of trading channels. It's actually one way, but in two different types of channels. And it's always trading inside the channel. And more often than not, the price does stay in the channel. But sooner or later, of course, the price will break the channel. And that's why there's an alternative strategy where, in this case, instead of opening a sell order, you would open a buy order. And you would expect the price to go somewhere out of the channel. You would use this strategy when your other analysis is telling you that this channel is getting too old and the price is going to break through it. So when a channel is quite new, there's more chances that the price will stay inside. When the channel has been around for a while, the chances of the price breaking out are constantly growing. Both strategies are valid. Depends on the situation and what your other technical analysis tells you. So to sum up with channels, direction, trade with the channel, stay inside the channel. It's more likely that the price will bounce into the channel. There's an alternative strategy, which is a breakthrough strategy, and that is used when you expect the price to break free from the channel.